Joseph's College for Women Autonomous Vishakhapatnam. Welcome to St. Joseph's open web-based learning platform, So eLearn, for a soulful and enriching e-learning experience. Department of Commerce and Management, St. Joseph's College for Women Autonomous Vishakhapatnam presents SMOOC, St. Joseph's massive open online course on Fundamentals of Commerce. Fundamentals of Commerce. Module 4, Taxation. Chapter 4.3, Goods and Services Tax. I, Mrs. K. Pratyusha, Assistant Professor, Department of Commerce and Management, St. Joseph's College for Women Autonomous Vishakhapatnam. Learning objectives of Goods and Services Tax. The students will be able to know about GST and its evolution, and also able to understand the importance of GST and its registration. Also, learn what is input tax credit and different GST rates. Understanding GST, Goods and Services Tax. Welcome to this presentation on Goods and Services Tax GST. We will explore its key aspects and impact. GST is a value added tax in India and other countries as well. This presentation will cover its definition, benefits, structure, rates, and compliance. What is GST? Let's start with the basics. Definition: value added tax on goods or services for domestic consumption. It's a multi-stage tax with input tax credits at each stage. How it works: credit is given for input taxes paid at each stage. The key features are: it is an indirect tax and the destination based tax, and it is very comprehensive. Why GST? Why was GST implemented? There are four different reasons: no cascading effect, lower costs, tax compliance, unified market. No cascading eliminates the cascading effect of taxes. Here, cascading effect is the double taxation or tax on tax. To avoid that, GST was implemented. Lower cost reduces the cost of production as well as it reduces the prices also. Tax compliance increases tax compliance and revenue collection to the government. Unified market creates a unified national market. Structure of GST. There are four types of GST: CGST, SGST, IGST, UTGST. CGST, Central Goods and Services Tax, which is levied by the central government. SGST, State GST, which is levied by the state government. IGST, Interstate GST, on interstate supply of goods and services levied by the government. UTGST, Union Territory GST, levied in union territories individually. Let us see the different slab rates under GST. GST rates. GST has different rate slabs. It is divided into 5 different categories. Number 1, essential goods. All essential goods, you don't need to pay any GST. The percentage or the rate of tax is 0%. The next one is commonly used items. That is, on that we have to pay 5% of GST. Next one is most services. On services, we need to pay 12% GST. On luxury items, all luxurious goods, when you purchase, you have to pay 18% on GST. Sin goods, on this you have to pay 28% of tax. GST registration. Who needs to register for GST? Here we will see three different categories. Turnover limit based on annual turnover. Registration under GST is mandatory for all businesses whose annual turnover exceeds 40 lakhs in a financial year. This threshold is 20 lakhs for special category states such as Arunachal Pradesh, Assam, Meghalaya, Manipur, Mizoram, Nagaland, Sikkim, Tripura, Himachal Pradesh, and Uttarakhand. In these states, the limit for the turnover is 20 lakhs only. The next category is e-commerce. Compulsory for e-commerce operators. The people who are doing electronic commerce businesses, that is online businesses, they have to register for GST. And voluntary. Benefits of voluntary registration. GST returns. Understanding GST returns is a very crucial thing. Under GST returns, we will see types, due dates, and penalties. Types. Different types of GST returns. There are different types, up to 11 are there. We'll see different things. GSTR1, GSTR2, GSTR3B, GSTR4, GSTR5, GSTR5A, GSTR6, 7, 8, 9, 10, and 11. So first we will see GST return to be filed by. GSTR1 should be filed by every GST registered dealer. Whoever is registered under GST has to file this GSTR1 returns. GSTR2 should be filed by every GST registered dealer which are suspended. And GSTR3B, casual and normal GST taxpayers. GSTR4 should be filed by composition GST registered dealer. GSTR5 should be filed by non-resident persons not availing input tax credit. GSTR5A, OIDAR services provider. GSTIR6, input service distributors has to file this GSTR6. GSTR7 should be filed by persons deducting TDS and under GST. Under GST who is reducing or deducting this tax deducted at source has to file this GSTR7. GSTR8 should be filed by e-commerce operators collecting TCS, tax collected at source. GSTR9, annual return by every GST registered dealer. GSTR10 should be filed by cancellation or surrender of GST. Last one, GSTR11. It should be filed by a person having unique identity number. These has to be filed monthly, quarterly, or yearly. And also this GSTR10 should be filed only once, and GSTR11 should be filed 26th of next month. Next we'll see GST due dates, specific dates for filing returns. GSTR1 should be filed for monthly. Who are filing monthly, for them 11th of next month, and for quarterly filers 13th of next quarter. GSTR2, 15th of subsequent month. GSTR3B, for monthly filers it is 20th of next month. For quarterly filers it is 22nd or 24th of the next quarter, as notified for different states or union territories. GSTR5, non-resident taxpayers has to pay 20th of next month. GSTR 6. Input service distributors, they have to file the returns 13th of subsequent month. GSTR 7. Tax deductor, they has to file 10th of subsequent month. GSTR 8. E-commerce operators 10th of subsequent month. GSTR 10. Taxable person whose registration has been surrendered or cancelled within 3 months from the date of cancellation or date of cancellation order, whichever is later. CMP 8. Composition taxpayers quarterly 18th of subsequent quarter. Now we'll see penalties for late filing or non-compliance. Let us see different offences and different penalties under GST. Penalty for delay in filing GSTR, returns all from 1 to 11. The late fee is 100 rupees per day per act. So it is 100 under CGST and 100 under SGST. Total will be 200 per day. The maximum is 5,000 rupees. There is no late fee on IGST. Now, penalty for not filing GST. Penalty 10% of the tax due or 10,000 rupees, whichever is higher. Penalty for committing fraud under GST. Penalty 100% of the tax due of 10,000 rupees, whichever is higher. Penalty for helping a person to commit fraud. Penalty extending up to 25,000 rupees. Penalty for opting for composition scheme even though he is not eligible. Demand and recovery provisions of sections 73 and 74 will apply. Fraud case and non-fraud case. Under fraud case, penalty of 100% of tax due or 10,000, whichever is higher. Non-fraud cases, penalty 10% of the tax due or 10,000, whichever is higher. Next penalty, wrongfully charged GST rate or charging a higher rate. Penalty 100% of the tax due or 10,000 rupees, whichever is higher. Penalty for not issuing an invoice. Penalty 10,000 rupees or 100% of tax due, whichever is higher. Penalty for not registering under GST. Penalty 100% of the tax due of 10,000 rupees, whichever is higher. Penalty for indirect invoicing or incorrect invoicing, a penalty of 20,000 rupees. Input tax credit ITC. ITC is a crucial part of GST. Let us see what is ITC. Input tax credit. This is a credit for taxes paid on inputs. Input tax credit or ITC means the goods and services tax paid by a taxable person on any purchase of goods or services that are used or will be used for business. Input tax credit can be reduced from the GST payable on the sales by the taxable person only after fulfilling same conditions. These conditions given under GST law are more or less in line with the pre-GST regime, except for a few additional ones such as GSTR 2B. These rules are direct and may be stringent in nature. Let us see the conditions under input tax credit. Specific conditions for availing ITC. Section 16 of CGST Act lays down the conditions to be fulfilled by the GST registered buyers to claim ITC. The conditions are summarized. Such input tax credit is eligible for claims if the goods or services purchased are further used for business purposes and not for personal use. Buyers must hold such tax invoice or debit note or document evidencing payment towards the purchase. And such tax invoice or debit note is filed by the supplier in Form GSTR1 and it appears in the buyer's Form GST R2B. From 1st Jan 2022, the benefit of provisional ITC claims is no longer available as per section 16(2) subsection AA. It means the amount of ITC reported in GSTR 3B will be a total of actual input tax credit in GSTR 2B. The provisional ITC of 5% of actual ITC in GSTR 2B will no longer be allowed. Hence, a regular matching of the purchase registered or expensive ledger with GSTR 2B is crucial. Reverse charge under GST. The reverse charge mechanism is the method of paying GST by the recipient rather than the seller. In this situation, the recipient or receiver assumes the responsibility for tax payment rather than the seller. When is this reverse charge under GST applicable? Supply from unregistered or registered dealer. Reverse charge will occur if a seller who is not registered for GST supplied products to an individual who is registered under GST. This ensures that the GST would have to be billed directly to the government by the recipient rather than the seller. The licensed dealer who is required to pay GST under reverse charge must self-invoice for sales made. The customer would pay IGST on interstate sales. The customer must pay CGST and IGST, SGST on intrastate purchases under reverse charge mechanism. And services through e-commerce operators. When an e-commerce operator provides facilities, the e-commerce operator would be subject to reverse charge. He would be required to pay GST. CBEC specified supply of such goods and services. The CBEC has published a list of products and services that are subject to a reverse charge payment. According to Section 298 of the CGST Act of 2017, a reverse charge is the obligation to pay tax by the purchaser of delivery of products or services or both rather than the seller of those goods or services. Let us see the considerations of reverse charge mechanism. Even if their revenue does not reach the threshold, anyone paying tax through the reverse charge system is required to register under GST. The reverse charge GST must be deposited with the government on the 20th of each month. Only intrastate transactions will be subject to the reverse charge mechanism. The major challenges related to GST. GST has its own challenges. We have shown only three here. Refunds, ITC mismatch, different complexities. Complexity and compliance burden. GST in India has a complex structure with multiple tax slabs, leading to increased compliance requirements. This complexity poses a challenge for businesses, especially smaller enterprises, in understanding and adhering to the diverse regulations. Next one is technology and infrastructure readiness. The successful implementation of GST relies heavily on robust technological infrastructure. Issues such as lack of technological readiness among businesses and disparities in technology adoption can hinder the seamless functioning of the GST network. ITC verification, input tax verification. The government authorities have recently identified and busted more than 29,000 bogus firms involving in evading tax GST dues. Multiple registrations across states. Businesses operating in multiple states must register separately in each state for GST compliance. This multiplicity of registrations adds administrative burden and increases compliance costs for businesses with a pan India presence, contributing to logical challenging. Conclusion: GST's impact and future, its role, potential, amendments. GST's role in the Indian economy, scope for improvements and reforms, recent changes and their impact. GST is the biggest tax reform in India and founded on the nation of one nation, one market, one tax, dismantling all interstate barriers with respect to trade. The GST rollout with a single stroke converted India into a unified market of 1.4 billion citizens. The rollout renewed hopes of India's fiscal reforms program, regaining momentum and vendoring the economy. The role of GST has benefited the Indian economy in different ways. The transformation to GST marked a pivotal shift in India's tax landscape. By implementing a single transparent structure nationwide, both enterprises and consumers gained unprecedented visibility into their tax obligations. This revolutionary change brought several significant advantages to the Indian economy, like simplified tax structure, boosted tax compliance, ease of doing business, formulation of the economy, reducing the cascading effect. The impact of GST on the common man. For average citizens, GST implementation presents mixed outcomes in a daily life. Essential items and frequently used products fall under lower tax brackets or receive exemptions, protecting typical households from excessive taxation. However, luxury segment goods face higher rates, increasing their retail prices. GST's transparent structure enables consumers to clearly understand their tax obligations, fostering system wide trust and understanding. Talking about the long term benefits, it is expected that GST would not just mean a lower rate of taxes but also minimum tax slabs. Countries where goods and services tax has helped in reforming the economy apply only 2 to 3 rates, one being the mean rate, a lower rate for essential commodities, and a higher tax rate for the luxurious commodities. Thank you.